Let's jump right into this explainer. Today, we're talking about a high-stakes balancing act, mastering receivables management. Because, for any business, this isn't just about extending credit to people, it's about engineering exactly how, and more importantly, when, that cash actually makes it back into your bank account.
Think about it. What happens when your sales are absolutely skyrocketing, your P&L looks amazing, but your bank account is totally empty? We've all seen the danger of trapped cash. Sure, receivables look great as current assets on paper, but if they aren't translating into cash efficiently, you are staring down a massive liquidity risk. And that is exactly what we're going to solve today. So here's our roadmap for the day. First, the credit dilemma. 2, shaping your receivables. 3, costs versus benefits. 4, evaluating credit policies. 5, factoring and forfeiting. And finally, measuring success. Let's get to it. Starting off with Section 1, the credit dilemma. Okay, so it all really boils down to your credit policy. Think of this as your master set of levers. You pull them to either speed up or slow down your cash flow. If you're too lenient, you're risking absolutely disastrous bad debts. But if you're too strict, you kind of strangle your sales volume. It's a tightrope walk. It has to be perfectly balanced. Now, that credit policy basically operates on 4 key variables. First up, you have your credit standards. That's the baseline criteria for who even gets credit in the first place. Second is the credit period. The timeline for repayment, like a net 50. Third, the cash discount, which is giving them a little percentage off if they pay early. And fourth, collection effort. Basically, how aggressively are you going to chase down those overdue accounts? You tweak any of these and your whole financial landscape shifts. Ultimately, the total size of your receivables, meaning the actual physical amount of cash you have floating out there, depends on 3 major factors. It's dictated by just how strict that credit policy of yours is, the sheer volume of sales you're trying to hit, and the specific terms of trade credit you're offering. I mean, it makes sense, right? If you want more sales, you usually got to offer more credit, which obviously balloons the total size of your receivables. Moving on to Section 2, shaping your receivables. So execution is everything here. How do you actually decide who's good for it? Managers use what's called the 5 C's of credit evaluation to check an applicant's borrowing capacity and their ability to actually repay. You look at character, that's reflected in their credit history, capacity, meaning their debt-to-income ratio, collateral, which are the assets they can pledge as security just in case things go sideways and they default, capital, looking at their business's financial reserves, and finally conditions, so the external economic factors or, industry risks. By meticulously checking these 5 C's, you're actively shaping the quality of your receivables right out of the gate. All right, Section 3, costs versus benefits. Let's be real. The costs of extending credit can be pretty heavy. You've got capital costs because your funds have blocked, administrative costs just from dealing with all the paperwork, delinquency costs from having to constantly nag late payers, and of course, the dreaded defaulting costs, when that invoice officially just becomes a ghost. But on the flip side, the benefits are undeniable, right? Offering credit drives profit generation through higher sales, it really helps you win out against the competition, and it increases your overall rate of production. So there's definitely a sweet spot to all of this. A super rigid policy keeps your liquidity high, but it restricts your profitability, while a liberal policy boosts that profitability, but totally tanks your liquidity. So every single business has to find that optimum middle ground, that magic point where the incremental rate of return perfectly matches the incremental cost of capital. That intersection right there, that is where your firm maximizes its overall value. Which brings us to Section 4, evaluating credit policies. Okay, before you commit, there are 2 mathematical frameworks managers use to actually test these policies out. The total approach is pretty much exactly what it sounds like. You lay out the total expected profits and the total costs of your current policy, and you compare them entirely against the totals of any proposed policies. Simple enough. Then there's the incremental approach, which is a lot more laser-focused. It only looks at the marginal changes, so the extra revenue generated versus the extra costs incurred by shifting the policy. But, whichever approach you end up using, the ultimate advice is always the exact same. Adopt the policy that yields the highest net benefits. Next up, Section 5, factoring and forfeiting. So what happens if cash is tight right now? Domestic factoring is basically the outright sale of your accounts receivable to a financial agency, which we call a factor. Instead of sitting around waiting for a customer to pay, you just sell those invoices for immediate cash, and the factor does the collecting. Now, this can be with recourse, meaning you still take the hit if the customer ends up defaulting, or without recourse, where the factor completely bears that ultimate risk. It's a great way to inject liquidity instantly without taking on traditional loan debt. Now, if you're dealing with overseas buyers, that's where we look at forfeiting. Here, an exporter sells their goods, receives a letter of credit from the importer's bank, and then literally takes that letter to their own bank to get paid immediately. The cool thing here is this is almost always done without recourse, so it completely removes the super complex risks of international default, and it frees up your working capital on the spot. Pretty neat, right? And our final section, number 6, measuring success. All right, so how do you know if you're actually winning at this? Your ultimate scorecard is the receivables turnover ratio. That's your net credit sales divided by your average accounts receivable. This is an efficiency ratio, and it proves exactly how speedily your short-term debt is actually being collected. High numbers? Awesome. It means you're efficiently turning those IOUs into cold, hard cash. Low numbers? Well, that means your money is trapped.
Let's look at what this actually means in reality. In the source material, there's a really great illustration with a company called Enox Ltd. After running their gross credit sales and receivables through that formula, their daily sales outstanding, or DSO, comes out to exactly 54.75 days. Think about that for a second. That means, on average, it takes Enox almost 55 days to actually collect cash after making a sale. For management, this single number is a massive, glaring red or green light. I mean, if their credit policy is set to net 30, 54.75 days is an absolute disaster. It requires immediate corrective action. Because here's the reality. When you fail to manage your receivables, your money isn't just sitting there idle. It's working for someone else. So I'll leave you with this question to chew on. Is your trapped cash literally funding your customers' growth instead of your own? Mastering this balancing act is absolutely crucial. It is the only way to ensure your sales actually fuel your future. Take a really close look at your own ledger today. Ask yourself, what is your true cost of waiting?